Before we begin, a critical disclaimer. I am not a financial advisor, and this video is for educational and informational purposes only. The financial strategies discussed here carry significant risks and may not be suitable for everyone. You should always consult with a qualified and licensed financial professional, a mortgage broker, and a tax advisor in your state before making any decisions regarding your personal finances, your mortgage, or taking on new debt. Your financial situation is unique, and any action you take based on the information in this presentation is strictly at your own risk. Have you ever actually looked at your mortgage amortization schedule? Not just glanced at it, but really studied it? If you have, you know that for the first 5, 10, even 15 years of your 30-year loan, you're on a financial treadmill going nowhere fast. You make your payment of, say, $2,500, you feel responsible, you feel like you're building equity in your American dream. But then you look at the statement and realize that $2,000 of that payment just evaporated. It went straight into the bank's pocket as interest. Only $500, a tiny fraction, actually went to paying down the loan on your house. It's a soul-crushing realization. You realize that your $500,000 home will actually cost you over $1 million by the time you own it free and clear 30 years from now. It's a system designed to keep you paying the maximum amount of interest for the maximum amount of time. But what if I told you there's a controversial, and I mean highly controversial strategy that claims to flip this entire system on its head? A method that some people swear allows them to pay off that same 30-year mortgage in as little as 5 to 7 years, saving them hundreds of thousands of dollars in interest payments. It's a strategy that doesn't involve winning the lottery or getting a massive inheritance. It involves using a specific financial tool, a line of credit, in a very unconventional way to attack your mortgage principal with brute force. In this video, we are going to pull back the curtain on this exact strategy. We're not here to sell you a course or a coaching program. We're here to give you the unvarnished, unbiased truth. We're going to break down exactly how it works step by step using real numbers. We will explore the massive potential upsides, the pros that get people so excited. But more importantly, we are going to shine a very bright light on the significant and often hidden downsides. The cons, the risks, and the dangers that can lead to financial ruin if you don't know what you're doing. By the end of this presentation, you will understand this powerful concept, you will know who it might be right for, and you will know the critical red flags that tell you to run in the other direction. Now, I can hear the skepticism already. If this strategy is so amazing, why isn't my banker or mortgage broker telling me about it? Why isn't everyone doing it? That is the perfect question to be asking, and the answer is the entire reason we're making this video. The answer is risk, complexity, and discipline. This isn't a magic bullet. It's a high-performance financial engine, and if you don't know how to operate it, you're going to crash. To understand why this strategy even exists, we first have to understand the enemy, the traditional 30-year amortized mortgage. The word amortization comes from the Latin word amortir, which means to bring to death. And that's exactly what it's designed to do. Slowly kill a loan over a very long period. Let's use a simple example. Say you have a $400,000 mortgage at a 6% interest rate for 30 years. Your monthly principal and interest payment would be about $2,398. In your very first month, the bank calculates the interest you owe. They take your loan balance, $400,000, multiply it by the interest rate 0.06, and divide by 12 months. That comes out to exactly $2,000. So, when you make your $2,398 payment, a full $2,000 of it is pure interest, pure profit for the bank. Only $398 actually reduces your loan balance. Your new balance is now $399,602. Next month, the process repeats. The bank calculates the interest on your new, slightly lower balance. It comes out to $1,998. So, of your second payment, you pay a tiny bit less in interest and a tiny bit more, $400 goes to principal. You see the game here? The entire structure is front-loaded. The bank gets the majority of its interest profit from you in the first decade of the loan, when your balance is highest. You are essentially paying rent to the bank for the first 10 to 12 years, with very little to show for it in terms of actual home equity. Every dollar you pay is on their schedule, a schedule designed for their benefit. This is where the line of credit strategy enters the picture. Proponents of this method, sometimes called velocity banking, or the mortgage sweep strategy, argue that you can break free from this rigid amortization schedule. The key is to use a different kind of debt, specifically a home equity line of credit or HELOC. Unlike a mortgage, which is a lump sum loan with a fixed payment schedule, a HELOC functions more like a giant credit card secured by your house. It's a revolving line of credit. You can borrow money, pay it back, and borrow it again up to your credit limit. But here's the most important difference. The interest on a HELOC is typically calculated daily, based on the exact amount you owe on that day. It's simple interest, not amortized interest. This distinction is the entire foundation of the strategy. With a traditional mortgage, you can't just throw an extra $500 at it mid-month and immediately reduce the interest you owe for the rest of that month. You're locked into that amortization schedule. But with a HELOC, every single dollar you deposit, on any day of the month, immediately reduces the balance that interest is being calculated on. So, how does this all come together to pay off a mortgage? The basic theory is this. You use your income as a weapon to rapidly pay down a simple interest loan, which you then use to attack your amortized interest loan. It sounds complicated, so let's break down the core mechanic. Step 1 is to get a HELOC. Let's say you have enough equity in your home to get a $50,000 HELOC. Step 2 is the big scary move. You take a large chunk of money, say $30,000, from your HELOC, and you make a one-time, lump sum payment directly to the principal of your main mortgage. So your $400,000 mortgage is now instantly a $370,000 mortgage. Now you might be thinking, wait, didn't I just trade one debt for another? Yes, you did. You now owe $30,000 on your HELOC. But here's the crucial part. By making that $30,000 principal payment, you didn't just pay off $30,000 of your loan. You effectively vaporized all the future interest you would have paid on that $30,000 over the next 28 years. You have leapfrogged down your amortization schedule. You've skipped years of interest-heavy payments in a single transaction. Step 3 is where the velocity part comes in. You now direct your entire financial life towards annihilating that $30,000 HELOC balance. Instead of your paycheck sitting in a checking account that pays you 0.01% interest, you deposit your entire paycheck, every single dollar, directly into the HELOC. If you and your spouse make a combined $8,000 a month, you deposit that $8,000 straight into the HELOC. Your $30,000 balance instantly becomes a $22,000 balance. Because the interest is calculated daily, you have just dramatically reduced the amount of interest you'll pay on the HELOC for the rest of the month. You then use the HELOC like a checking account, paying all your monthly bills, your car payment, groceries, utilities directly from it. Let's say your monthly expenses are $5,000. Your balance would creep back up from $22,000 to $27,000 over the course of the month. But at the end of the month, you've still successfully paid down $3,000 of the balance, and you've had a much lower average daily balance than if you just left the $30,000 sitting there. You repeat this process month after month, using the full force of your income to rapidly drive down the HELOC balance. Once you've paid it off, you do it again. You take another $30,000 chunk, throw it at the mortgage principal, and repeat the cycle. By using your cash flow to aggressively pay down the simple interest HELOC, you are able to make massive strategic principal-only payments on the amortized mortgage, saving a fortune in interest and years off your loan. In theory, it sounds brilliant. It sounds like a cheat code for the middle class to beat the banks at their own game. But here's the catch, and it's a massive one. This strategy is like handling financial dynamite. The interest rate on a HELOC is almost always variable, meaning it can skyrocket if the Federal Reserve raises rates. It requires an ironclad budget and incredible personal discipline. One misstep, one major unexpected expense, one job loss that interrupts your cash flow, and the entire house of cards can come crashing down, leaving you with 2 large debts and potentially in a worse position than when you started. It transforms a stable, predictable mortgage into a high-stakes, active management situation that is simply not for everyone. And that's just scratching the surface of the risks involved. So let's pull back the curtain and stare directly at the first, and perhaps most obvious monster hiding in the closet: the variable interest rate. Your 30-year fixed-rate mortgage is a rock. It's predictable. It's boring in the best possible way. You know exactly what your principal and interest payment will be this month, next year, and 10 years from now. It's a financial anchor in the stormy seas of economic uncertainty. A home equity line of credit, or HELOC, is not an anchor. It's a kite, tied to the volatile winds of the Federal Reserve's interest rate decisions. When proponents of this strategy talk about paying less interest, they often show you charts and graphs based on a low interest rate environment. And for a while, that was the reality. But what happens when the economic weather changes? Imagine a couple, let's call them Mark and Jessica. They have a 3.5% fixed-rate mortgage. They hear about this amazing strategy, take out a massive HELOC at a promotional rate of 4%, pay off their mortgage and start aggressively paying down the HELOC. For the first year it feels like magic. They're crushing their debt. They feel like geniuses. Then inflation starts to creep up. The Fed signals it's going to start raising rates to cool down the economy. Their HELOC, which is tied to the prime rate, starts to adjust. First, it goes from 4% to 4.75%. Their minimum payment ticks up, but it's manageable. They tighten their belts. Then it hits 5.5%, then 6.5%. Suddenly, the interest they're paying each month on their HELOC is more than the interest they were paying on their safe mortgage. The financial tailwind they were riding has turned into a brutal headwind. The payment that was once a tool for getting ahead is now a weight dragging them down. Every dollar they throw at it feels like it's being eaten by interest. This isn't a hypothetical. This is the reality millions of Americans with variable rate debt have faced over the last couple of years. You're essentially making a bet. You're betting that interest rates will stay low or go down. But you're not betting with chips at a casino. You're betting with the roof over your head. It's a gamble where the house, in this case the central bank, can change the rules of the game at any time without asking for your permission. This leads us directly to the second, more insidious risk, the discipline dilemma. The structure of a traditional mortgage is a form of forced financial discipline. Every single month, a portion of your payment is automatically chipping away at your principal balance. You are building equity by default. You don't have to think about it, it just happens. Swapping this for a HELOC is like firing your personal trainer and replacing your carefully planned diet with a 24/7 all-you-can-eat buffet, then expecting to get in the best shape of your life. A HELOC is an open line of credit. When you pay it down, that credit becomes available again. Let's go back to Mark and Jessica. They've been diligently paying down their HELOC for 2 years and have knocked $40,000 off their balance. They feel proud. But then the transmission on their car goes out. It's a $5,000 repair. With a traditional mortgage, they'd have to find that money somewhere else, savings, a personal loan. It would be painful, forcing them to confront the real cost. But with the HELOC, the temptation is immense. The money is just sitting there. So easy. We'll just draw on the HELOC to cover it, they say. We'll pay it right back. A few months later, they decide they deserve a vacation after being so stressed about interest rates. Another $7,000 goes on the HELOC. Then a home renovation project goes over budget. Another $10,000. Before they know it, a year has passed, and their balance is not $40,000 lower. It's right back where they started or even higher. They haven't been paying down their house. They've been using their house as a giant high-interest ATM. This psychological trap is the single biggest reason this strategy fails for most people. It requires a level of fiscal monkhood that is incredibly difficult to maintain over a period of years. Through all of life's unpredictable ups and downs, a mortgage protects you from your worst financial impulses. A HELOC exposes you to them. But even if you have the discipline of a saint and the luck of a lottery winner with interest rates, there is a third catastrophic risk lurking in the fine print of your HELOC agreement. It's a clause that most people don't even know exists. It's called a call provision or a demand feature. What this means is that under certain circumstances, the bank has the right to demand you pay back the entire loan, in full, immediately. Or they can freeze or reduce your line of credit with no warning. Sound terrifying? It should. So what triggers this financial doomsday device? The most common reason is a significant drop in your home's value. Think back to 2008. The housing market imploded. People who were using this very strategy suddenly found themselves in an impossible situation. Their home, which was the collateral for their massive line of credit, was now worth 30% or 40% less. The bank, panicking about its own risk, looks at the loan and says, "This is no longer secure." They trigger the call provision. Now a homeowner who has never missed a payment is suddenly on the hook for a $300,000 balloon payment due in 30 days. Where are they supposed to get that kind of money? They can't refinance because the home's value has plummeted and no other bank will touch it. Their credit line is frozen, so they can't borrow more. They are trapped. This is how people lose their homes. It's not a slow process of falling behind on payments. It's a sudden, brutal trapdoor opening beneath them. Your predictable 30-year mortgage doesn't have this feature. As long as you make your payments, you are safe. With a HELOC, you can be a perfect borrower doing everything right and still face foreclosure because of larger economic forces completely outside your control. You're handing the keys to your financial future over to the whims of the housing market and the risk assessment department of your bank. So we have interest rate risk that can turn your payments into a moving target, discipline risk that preys on human nature, and the catastrophic collateral risk that could cost you your home overnight. After hearing all of that, you might be thinking this is the single worst financial idea in American history. You might be ready to write it off completely, but that would be a mistake. Because for a very specific type of person, in a very specific situation with an almost inhuman level of discipline, this strategy can work. And the rewards, the speed at which you can achieve true financial freedom, can be breathtaking. The question is, are you that person? In the next part, we're going to build the psychological and financial profile of the ideal candidate for this high-wire act, and break down the exact numbers that separate success from disaster. So let's build this person. Let's construct the profile of the individual who can actually pull this off, starting with the mind. Because before you ever look at a single bank statement, you have to look in the mirror. The financial part is just math. The psychological part, that's the real battlefield. First, and this is non-negotiable, you must possess a level of financial discipline that borders on obsession. I don't mean you're pretty good with your money. I don't mean you pay your credit cards on time. I mean you are the person who tracks every single dollar. You have a budget, and it's not just a vague idea in your head. It's a living document. You treat your household finances with the same seriousness a CEO treats a Fortune 500 company's balance sheet. If the thought of reconciling your accounts every single week sounds like a nightmare, you are not a candidate. This strategy is not a crock pot. You can't set it and forget it. It's a sizzling hot wok that you have to constantly stir, or everything will burn to a crisp. A traditional 30-year mortgage is designed for passivity. This strategy is designed for active, relentless engagement. You are not a passenger. You are the pilot, the navigator, and the air traffic controller all at once. Second, you need an almost clinical emotional detachment from large sums of money. The moment you execute this strategy, you will wipe out your mortgage, which feels incredible. But in its place, you will have a home equity line of credit with a balance of, say, $300,000. That number will be staring you in the face every single day on your banking app. For most people, seeing a debt that large, a debt that isn't neatly packaged into a 30-year plan, is terrifying. It feels like standing on the edge of a cliff. The ideal candidate doesn't see a cliff. They see a tool. They see a number on a screen that they have a clear mathematical plan to drive to zero. If you are the kind of person who gets anxiety when your checking account dips below a certain number, or who feels a jolt of panic seeing a massive credit line balance, this will eat you alive. You have to be able to look at a $250,000 debt and feel nothing but the cold, hard calculus of your plan. Third, you must have a deep-seated distrust of lifestyle inflation. The single greatest enemy of this strategy isn't the bank. It's not interest rates, it's you. It's the human tendency to see available credit and think, I can afford that. The HELOC will feel like a bottomless bank account. A new car, a vacation, a kitchen remodel. It's all just a check away. The person who succeeds with this strategy views that HELOC not as a source of funds, but as a financial black hole they are actively trying to close. Every dollar of surplus income is a weapon to be used against the debt. It is never, ever seen as an opportunity for a shopping spree. If you get a raise at work, your first thought cannot be, great, now we can afford a boat. Your first thought must be, great, I can increase my monthly principal paydown by another $400. It's a fundamental shift in mindset from consumer to debt destroyer. Now let's move from the mind to the wallet. The psychological profile is the software, but it's useless without the right hardware. The financial requirements are just as strict, if not more so. The absolute cornerstone of this entire strategy is a massive, consistent, and predictable cash flow surplus. Let's be crystal clear about what this means. Take your total monthly take-home pay, after taxes, after 401k contributions, after health insurance, everything. Then subtract every single one of your living expenses. Groceries, gas, utilities, insurance, cell phones, internet, subscriptions, entertainment, everything except your mortgage payment. The number you are left with is your surplus. For this strategy to even be remotely viable, that surplus must be substantial. We're not talking about a couple $100s. You need a surplus that is, at a minimum, equal to or greater than what your full mortgage payment was. Let's put some real numbers on this. Let's say your mortgage principal and interest is $2,000 a month. You need a pre-mortgage surplus of at least $2,000, and ideally much more. Why? Because this surplus is the engine that drives the whole thing. Let's walk through the math. Imagine you have a $300,000 mortgage remaining. You get a HELOC and pay it off in full. Your mortgage is gone. Hooray! But now you have a $300,000 balance on your HELOC. Let's say your combined take-home pay is $10,000 a month. And let's say your total monthly living expenses are $5,000. This leaves you with a $5,000 monthly surplus. This is the key. Here's how it works in practice. Your entire $10,000 paycheck gets direct deposited into your HELOC account. The moment it hits, your $300,000 balance is instantly reduced to $290,000. For every day that money sits there, you are being charged interest on a much lower principal balance. Throughout the month, you pay all your $5,000 in bills directly out of the HELOC. So, the balance slowly creeps back up from $290,000 to $295,000 by the end of the month. Then, the next month, your next $10,000 paycheck hits. The balance immediately drops to $285,000. You spend your $5,000, it creeps up to $290,000. You see the pattern? In 2 months, you've paid down $10,000 in principal. Compare that to your old mortgage. On a 30-year, $300,000 loan at 6%, in the first 2 months, you would have made $4,000 in payments, but only about $900 would have gone to principal. The other $3,100? Vanished. Poof. To the bank's profit line. With the HELOC, every single dollar of your surplus, all $5,000 of it, is a direct principal reduction from day one. This is the interest cancellation effect they talk about. You are dramatically reducing the average daily balance on which the bank calculates your interest. But this only works with that massive surplus. If your take-home is $10,000 and your expenses are $9,500, your surplus is only $500. You're barely making a dent. You're exposing yourself to all the risk of a variable rate loan for a reward that is marginal at best. The second financial requirement is a rock-solid emergency fund that is completely separate from your home equity line of credit. I cannot stress this enough. Using your HELOC as your emergency fund is like using a parachute to anchor a boat. It's the wrong tool for the job and will lead to disaster. You need 6 months of living expenses liquid in a high-yield savings account that you do not touch. If you lose your job or have a major medical expense, you draw from this fund. You do not, under any circumstances, run up the balance on your HELOC. The moment you start adding new debt to the line of credit you're trying to pay down, the game is over. You've lost. That separate emergency fund is your firewall. It's what allows you to continue executing the plan, even when life throws you a curveball. So, the ideal candidate is a psychological fortress with a financial bazooka. They are disciplined, emotionally detached from debt, and allergic to lifestyle creep. Financially, they have a stable, high income that generates a massive monthly surplus, and they have a fully funded separate emergency fund. They are a rare breed. They have the financial horsepower and the mental toughness to stay the course. If you're listening to this and thinking, that's me, then you might just have what it takes. But being the right person is only half the battle. You also have to be fighting on the right terrain with the right equipment. Because even the most elite financial operator can be taken down by a hidden trap in their loan agreement or a sudden shift in the economic landscape. We've built the perfect soldier for this financial war. But even the best soldier can step on a landmine. In the next part, we'll map out every single one of those landmines, from the fine print on your HELOC agreement to the silent threats from the Federal Reserve that could derail your entire plan overnight. Alright, let's start by mapping the biggest, most camouflaged landmine of them all. It's the one most people don't even see until their financial legs have been blown clean off. I'm talking about the interest rate. Your 30-year fixed mortgage is a fortress. That rate you locked in, whether it was a dreamy 2.8% or a manageable 6.5%, is written in stone. It's your anchor in a stormy economic sea. A home equity line of credit, or HELOC, is not a fortress. It's a raft. And it's tied directly to the hurricane machine at the Federal Reserve. Nearly every HELOC in America is a variable rate product. This isn't some minor detail in the fine print. It is the central nervous system of the entire loan. The rate you pay is almost always calculated as the prime rate plus a margin. The margin is the bank's profit, maybe it's 1%, maybe it's 0.5%. That part is fixed. But the prime rate, that's the part that moves. And it doesn't just move, it can surge like a tidal wave. The prime rate is the interest rate that banks charge their most creditworthy customers, and it follows the federal funds rate, the rate set by the chairman of the Federal Reserve, almost in lockstep. So let's translate this. When you hear on the news that Jerome Powell and the Fed are raising rates to fight inflation, what they're really saying is, we are actively making your HELOC more expensive. You've essentially handed the remote control for your monthly house payment to a small group of economists in Washington, D.C., whose job is to manage the entire U.S. economy, not your personal budget. Let's make this real. Imagine you executed this strategy perfectly in early 2022. You had a $400,000 mortgage, and you paid it off with a new $400,000 HELOC. At the time, the prime rate was a whisper-quiet 3.25%. Let's say your margin was 0.5%, so your total rate was 3.75%. Your interest-only payment would have been about $1,250 a month. Manageable, right? You're feeling like a genius. But then inflation started raging, and the Fed started hiking, and hiking, and hiking. By the summer of 2023, the prime rate had rocketed to 8.5%. Your rate was now 9%. That same $1,250 monthly payment just exploded to $3,000. It more than doubled in just over a year, through no fault of your own. All that savings you were supposed to be making? It's been vaporized by a force completely outside of your control. That's the first landmine. You're not in a fixed fight. You're in a variable one, and your opponent is the most powerful financial institution on Earth. Now for the second landmine, and this one is a ticking time bomb built directly into the structure of the loan. It's called the end of draw period. A HELOC is split into two distinct phases. The first is the draw period, which is usually the first 10 years. During this time, it acts like that magical financial tool we've been talking about. You can borrow money, pay it back, and borrow it again, all while typically only being required to pay the interest each month. This is the honeymoon phase. It feels easy, flexible, and seductive. But then after 10 years, the clock strikes midnight. The draw period ends, and the repayment period begins. And it is a completely different animal. The credit line freezes solid. You cannot borrow one more dollar. The flexibility is gone. But that's not the worst part. The bank turns to you and says, okay, that massive balance you've been carrying, it's time to pay it all back. With interest and principal. Over the next 20 years. Your payment is no longer a simple interest-only calculation. It suddenly transforms into a fully amortizing loan payment. This creates a financial shockwave that has leveled countless family budgets. Let's go back to our example. You have that $400,000 balance and rates have settled at, say, 7%. During the draw period, your interest-only payment is a hefty $2,333 a month. But the second that repayment period kicks in, assuming a 20-year term, your new mandatory monthly payment skyrockets to $3,101. That's an almost $800 a month increase overnight for the exact same debt. It's like you've been jogging on a treadmill for 10 years and someone suddenly cranks the speed and the incline to the absolute max. Many people who enter this strategy don't fully grasp this. They see the low initial payment and plan their life around it, not realizing that a cliff is waiting for them a decade down the road. This brings us to the third, and perhaps most insidious landmine, the human element. The entire HELOC payoff strategy rests on one single fragile pillar: absolute, unwavering superhuman financial discipline. A traditional 30-year mortgage is brilliantly designed for human imperfection. It's a forced savings plan. Every month you make a payment and a little piece of it, the principal, chips away at your debt. It's automatic. You don't have to think about it. It protects you from your own worst impulses. The HELOC strategy obliterates those guardrails. It takes your single largest asset, your home equity, and turns it into a giant liquid checking account. The gurus tell you to dump your entire paycheck into the HELOC to lower the balance and save on interest, and then use the HELOC to pay all your bills. This works beautifully on a spreadsheet, but we don't live on spreadsheets. We live in the real world. In the real world, your air conditioner dies in the middle of July. Your kid needs braces. Your spouse sees an unbelievable deal on a cruise to Alaska. With a traditional mortgage, you'd have to save up, or maybe put it on a high-interest credit card, which feels painful and stupid. But with a HELOC, the temptation is immense and frictionless. The money is just there. We'll just pull $5,000 from the HELOC for the new AC. It's an emergency. We can cover the braces with the HELOC, we'll pay it back. Before you know it, you're not just paying your bills with the HELOC, you're financing your lifestyle with your house. Your balance isn't shrinking. It's growing. You haven't created a system to pay off your mortgage faster. You've created a doom loop that can lead you to owe more than you started with, all at a terrifying variable interest rate. And finally, there's the landmine buried in the fine print of your loan agreement. It's the one that proves the bank is not your partner, It is always and only looking out for itself. The bank has the right to freeze, reduce, or even close your line of credit, often with very little warning. This is called an adverse action, and they can do it for a number of reasons. Did your credit score drop? They might get nervous. Did you lose your job? They might freeze your line. But the biggest trigger is a widespread economic downturn. Remember 2008? The housing market crashed. Millions of people who were using their HELOCs as emergency funds suddenly got letters in the mail. The letters basically said, due to falling property values in your area, your home is no longer worth what it was. Your line of credit is now frozen. Imagine the horror. You followed the plan. You paid off your mortgage and now have a $400,000 balance on your HELOC. You lose your job in a recession and you think, okay, it's scary, but at least I can tap the HELOC to survive until I find a new one. And then the letter arrives. The bank just took away your umbrella in the middle of a hurricane. You're now stuck with a massive, variable rate debt that you have to pay every month, with no job, and the emergency fund feature of the loan has vanished into thin air. You have all of the risk and none of the reward. So we've mapped the minefield. The Fed hijacking your interest rate. The payment shock at the end of the draw period. The siren song of easy credit that preys on human nature. The bank's ability to pull the rug out from under you at the worst possible moment. It looks terrifying. It looks like a fool's errand. So why on earth would anyone with a brain even consider this strategy? Well, it's because if you can navigate this minefield, and there is a way, the prize on the other side isn't just a paid-off house. It's a level of financial freedom most people can only dream of. In the next part, we'll introduce you to the velocity banking gurus and break down the exact math they claim can make you mortgage-free in 7 years, and we'll see if it actually holds up under scrutiny. So you step into their world. A world of online seminars, late-night YouTube rabbit holes, and PDF guides promising the secret the banks don't want you to know. The people preaching this strategy, often called velocity banking, or the HELOC strategy, are charismatic. They speak with the unshakable confidence of someone who's discovered a cheat code for the game of life. They don't talk like your stuffy financial advisor. They talk like a friend who's letting you in on a revolutionary secret. And the promise they make is hypnotic. Pay off your 30-year mortgage in 5 to 7 years. Not by earning more money, not by living on ramen noodles, but by being smarter than the bank, by using their own tools against them. So, what is this secret system? How does it actually work? Let's break down the blueprint they lay out step by step. First, the cornerstone of this entire strategy. You need a home equity line of credit, or a HELOC. This isn't a traditional loan. Think of it as a giant, government-regulated credit card, but with two huge differences. The credit limit is based on the equity you have in your home, and the interest rate is usually much lower than a credit card because your house is the collateral. To the velocity banking gurus, this HELOC isn't debt. It's a financial weapon. It's your primary tool for attacking the mortgage. Step 2 is what they call the chunk down. Forget making your normal monthly mortgage payment. Instead, you take a massive chunk of cash from your new HELOC, let's say $20,000, and you make a single lump sum payment directly to the principal of your mortgage. This is a critical detail. You're not just paying ahead. You are surgically removing a piece of the loan's core, the part that generates all the future interest. Now, this is where most people get nervous. You've just paid down one loan by taking on another, and at a potentially higher variable interest rate. Feels like robbing Peter to pay Paul. But this is where the velocity part of velocity banking kicks in. Step 3 is the cash flow redirect. This is the most radical change to your financial life. You take your paycheck, all of it, every single dollar, and you deposit it directly into your HELOC. Your traditional checking account becomes obsolete. It's a ghost town. Your entire financial world now revolves around this line of credit. Which brings us to step 4, you live off the HELOC. Your HELOC now functions as your checking account. You use it to pay for everything. Your groceries, your gas, your utility bills, your kids' soccer fees, your Netflix subscription. Everything is paid for by drawing from the HELOC. I know what you're thinking. This sounds insane. How does shuffling debt around and living off a line of credit possibly help you get ahead? The magic, according to the proponents, lies in the difference between how mortgage interest and HELOC interest are calculated. Your mortgage is an amortized loan. In the early years, your payment is almost entirely interest. On a $300,000 loan, that first $1,800 payment might only have $300 going to principal. The other $1,500? Poof, gone to the bank. It's a slow, agonizing crawl. A HELOC, however, uses simple interest, calculated on the average daily balance. And this is the key. By dumping your entire paycheck into the HELOC, you are immediately and dramatically lowering its balance, even if it's temporary. For every day that money sits in the HELOC before you spend it on bills, you are saving interest. Your money is no longer sitting uselessly in a checking account earning zero. It's actively working every single day to reduce the balance of your debt. Let's put some real numbers on this. Let's imagine a typical American family, the Millers. They have a $300,000 mortgage at a 6% interest rate. Their monthly principal and interest payment is about $1,800. They bring home $6,000 a month after taxes, and their total monthly expenses, food, car, utilities, everything, are $4,000. This leaves them with $2,000 of positive cash flow each month. Under the old model, they'd make their $1,800 mortgage payment, spend their $4,000, and maybe put the leftover $200 in savings. It would take them 30 years to pay off the house, and they'd pay over $347,000 in interest alone. Now let's apply velocity banking. The Millers get a $50,000 HELOC with a variable rate. Let's say it's at 8% right now. Month 1, they execute the plan. They take a $20,000 chunk from the HELOC and fire it directly at their mortgage principal. Instantly, their mortgage balance drops from $300,000 to $280,000. They have just skipped years on their amortization schedule. All those early payments where only a few $100s hit the principal, they just leapfrogged them. Now they have a $20,000 balance on their HELOC. On payday, their $6,000 paycheck goes directly into the HELOC. The balance immediately drops from $20,000 to $14,000. Throughout the month, they use the HELOC to pay their $4,000 in expenses. As they spend, the balance slowly creeps back up. By the end of the month, the balance is at $18,000. The proponents will tell you to look at what just happened. Instead of their $2,000 in positive cash flow sitting in a bank account or being dribbled out, that entire $2,000 went directly to paying down debt. Their net debt position improved by $2,000 in 1 month. The interest they paid on the HELOC for that month, on an average balance of say $16,000, would be about $107. But, they argue, the interest they saved on the mortgage is permanent. That $20,000 they wiped out is no longer accruing that 6% interest, saving them $100 a month for the rest of the loan's life. In 10 months, their $2,000 a month cash flow will have completely paid off the $20,000 they borrowed from the HELOC. The balance is zero. So what do? They do it again. They take another $20,000 chunk, fire it at the mortgage, and repeat the process. Chunk and repeat. Chunk and repeat. Each time they are converting a huge piece of long-term, slow-moving amortized debt into short-term, rapidly collapsing simple interest debt. They are using their cash flow like a battering ram, relentlessly smashing down the principal. This is the core pitch. It's a strategy built on the concept of making your money work for you 24/7. Instead of your paycheck sitting idle, it's actively suppressing interest from the moment it hits your account. Proponents call this the one pool of money concept. Your income, your expenses, your debt. It all flows through one simple, efficient tool. On paper, the math seems to work. The logic feels sound. It's an elegant financial maneuver that appears to turn the tables on the lenders. You're using the bank's own product, a line of credit, to accelerate your payment on their other product, the mortgage, saving you hundreds of thousands in interest and decades of your life. But if it's this easy, if it's this revolutionary, why isn't everyone doing it? What are the gurus conveniently leaving out of their seminars? What are the critical flaws and the dangerous risks hidden inside the velocity banking strategy? The very things that could turn your dream of financial freedom into a devastating financial nightmare. The first and most immediate danger is the interest rate itself. Your 30-year fixed mortgage is a fortress of predictability. You know exactly what your principal and interest payment will be this month, next year, and 10 years from now. It's a financial anchor in the stormy sea of economic uncertainty. A home equity line of credit, or HELOC, is the exact opposite. It is almost always a variable rate product. This isn't a minor detail. It is the central fatal flaw for most people. A variable rate means your interest rate is tied to a benchmark, usually the prime rate, which dances to the tune of the Federal Reserve. When the Fed raises interest rates to fight inflation, the rate on your HELOC can jump overnight. Let's make this real. In early 2022, you might have gotten a HELOC with an introductory rate of 3.5 or 4%. You could have run the numbers, looked at your budget, and thought, I'm a genius. This is going to save me a fortune. But then the Fed began one of the most aggressive rate hiking cycles in modern history. Suddenly, that 4% HELOC is now 8%, then 9%, then even higher. The monthly interest you're paying has more than doubled. The beautiful mathematical equation that was supposed to save you thousands has just exploded in your face. You've traded the stability of a fixed-rate mortgage for a ticking time bomb. And the fuse is lit by people in Washington, D.C., who don't know or care about your personal financial plan. You have effectively handed over control of your single biggest monthly expense to the whims of the national economy. This is a gamble of epic proportions, and you're betting your house on it. But let's say you're a risk taker. You think you can handle the interest rate fluctuations. The second hidden danger is far more personal. It's not about the bank or the Fed. It's about you. This strategy demands a level of financial discipline that is, frankly, almost superhuman. A traditional mortgage is a forced savings plan. The bank takes your payment every month, and a little piece of your principal disappears. It's slow, it's boring, but it's automatic. It works because it's rigid. A HELOC, on the other hand, is a giant, open, easily accessible pool of cash. Once you pay down the balance, that credit becomes available again. It's like replacing your mortgage with a credit card that has a six-figure limit. The gurus tell you to dump your entire paycheck into the HELOC to lower the average daily balance. This is mathematically sound. But what they don't tell you is that you also have to pay all your bills, your groceries, your gas, your insurance, your kids' soccer fees, out of that same HELOC. You are turning your primary checking account and your mortgage into one giant swirling vortex of money. Imagine this scenario. You do everything right for 6 months. You've paid down an extra $10,000 on your balance. You feel amazing, you feel in control. Then the transmission on your car dies. It's a $4,000 repair. With a traditional mortgage, you'd have to find that money in your emergency fund or savings. It would be painful. But with the HELOC, the money is just there. So easy. A few clicks on your banking app, and the bill is paid. No big deal, right? You'll catch up next month. But then a month later, you see an incredible deal on a family vacation. You deserve a break. You've been working so hard on this new financial plan. The money is just sitting there, waiting. Before you know it, you haven't just erased the progress you made. You've gone backwards. You now owe more on your HELOC than you did on your original mortgage. You've turned your home equity, the wealth you spent years building, into a slush fund for your lifestyle. And you're paying a high variable interest rate on that vacation and that car repair. This psychological trap is the #1 reason this strategy fails. Preys on human nature, and for most people, the temptation is simply too great to resist. The third landmine is a technical one, but it's just as devastating. It's called the payment shock at the end of the HELOC's draw period. Most HELOCs are structured in 2 phases. The first phase, typically lasting 10 years, is the draw period. During this time, you can borrow and repay money as you please, like a credit card. Crucially, your required monthly payments are often interest-only. This makes the payment seem incredibly low and manageable, lulling you into a false sense of security. But what happens when those 10 years are up? The draw period ends. Your line of credit is frozen. You can no longer borrow from it. The second phase, the repayment period, begins. And this is where the nightmare starts. The entire remaining balance on your HELOC is converted into a fully amortizing loan that you must pay off over the remaining term, which might be 15 or 20 years. Your monthly payment is recalculated to include both principal and interest, and it skyrockets. Let's run the numbers. Suppose you have a $200,000 balance on your HELOC near the end of the draw period. With a 7% interest rate, your interest-only payment would be about $1,167 per month. You've gotten used to this payment. It's built into your budget. But the day the draw period ends, that $200,000 balance is now a 15-year amortizing loan. Even if the interest rate magically stays at 7%, your new required monthly payment just jumped to $1,798. That's an extra $631, a more than 50% increase, hitting your budget like a freight train, overnight, with no warning. If rates have gone up to 9%, that new payment is over $2,027. This payment shock has been the catalyst for countless foreclosures. People who thought they were being clever find themselves unable to afford their home just a decade later. Finally, there's the risk that no one ever talks about because it reveals the true power imbalance between you and the bank. The bank can change the rules of the game at any time. A HELOC is not a covenant written in stone like your fixed-rate mortgage. It's a revolving line of credit that the bank can alter, reduce, or even freeze at their discretion. This is buried deep in the fine print of your agreement. And when are they most likely to do this? At the absolute worst possible time for you, during a recession, when the stock market is crashing, when unemployment is rising, when property values are falling. Think back to 2008. Millions of Americans had their HELOCs frozen, or their credit limits slashed with almost no notice. Imagine you've successfully moved your entire mortgage over to your HELOC. You're using it exactly as the gurus advise, with your paycheck going in and your expenses going out. Then, the economy hits a rough patch, and home values in your neighborhood drop by 20%. The bank's algorithm flags your account as high risk. You get a sterile, formal letter in the mail. Dear customer, due to current market conditions, your home equity line of credit has been frozen. You may no longer draw funds, and your credit limit has been reduced to your current outstanding balance. In that moment, your entire financial system collapses. The wellspring of cash you were using to pay your bills has been shut off. The liquidity you thought you had has vanished. You are now stuck with a massive variable rate loan secured by your house, and you've lost the very mechanism that was supposed to help you pay it off quickly. You are trapped. You've taken all the risk, and the bank has a safety hatch to protect itself, leaving you completely exposed. It's the ultimate financial rug pull, and it happens far more often than you think. So let's talk about why this happens. Why would a bank give you a massive line of credit and then snatch it away right when you need it most? It's not personal. It's not because a loan officer has something against you. It's cold, hard, algorithmic risk management. Banks are constantly monitoring the economy, not just nationally but regionally and even down to your specific zip code. When they see property values start to soften or stagnate in your area, their risk models light up like a Christmas tree. Think about it from their perspective. They gave you a loan, the HELOC, secured by the equity in your home. If your home's value drops from, say, $500,000 to $420,000, that equity they were leaning on has started to evaporate. To them, the loan just became significantly riskier. They aren't in the business of taking risks. They are in the business of mitigating them. So what's their easiest, fastest, and most legally sound way to reduce their exposure? They freeze or reduce your credit line. It's a simple clause buried deep in the fine print of the agreement you signed that gives them the right to do this at their sole discretion, for almost any reason tied to market conditions. They see the storm clouds gathering on the horizon, and they pull their ships back into the harbor, leaving your little boat to face the hurricane alone. Let me tell you about a couple. We'll call them Mark and Sarah. In 2006, they were the poster children for this strategy. They had a $300,000 mortgage on their home in a booming Phoenix suburb. They were diligent, disciplined people. They read the books, they went to the seminars, they built the spreadsheets. They took out a $350,000 HELOC, paid off their mortgage in a single transaction, and started the chunk down method. For the first year, it was magic. Every 2 weeks, Mark's paycheck would hit their checking account, and they would immediately transfer almost all of it to the HELOC, watching the balance drop. They'd live off the HELOC for their monthly expenses, using it like a credit card, but the big principal payments were making a huge difference. They calculated they'd be debt-free in under 7 years. They felt like they had discovered a secret cheat code to the game of life. They were telling their friends, their family, anyone who would listen about this incredible financial hack. Then came 2008. It started slowly. News reports about subprime lending. A few neighbors having trouble selling their homes. Then the ground gave way. The entire financial world began to crumble, and the epicenter of the housing collapse was in places exactly like their Phoenix suburb. One Tuesday afternoon, Sarah went to the mailbox and found a crisp, white envelope from their bank. It wasn't a statement. It was a single sheet of paper. The language was cold, corporate, and utterly devastating. It said something to the effect of, "Dear Mr. and Mrs. Miller, due to current market volatility and a reassessment of property values in your area, we are writing to inform you of a change to your home equity line of credit. Effective immediately, your credit limit has been adjusted to $285,000. Sarah read it twice. She didn't understand. Their current balance on the HELOC was about $284,500. She called Mark at work, her voice trembling. He didn't get it at first. "What do you mean adjusted?" he asked. "They can't do that." "Oh, but they could." And they did. The bank had looked at their balance, looked at the collapsing value of their home, and drew a line in the sand. They reduced the credit limit to be just a few $100s more than what Mark and Sarah already owed. Their massive, flexible $350,000 financial tool was gone. It was now just a $285,000 loan with a variable interest rate. The mechanism was broken. The slingshot was snapped. Their paycheck still came in, but they could no longer make a chunk payment. Why? Because if they paid the balance down to, say, $270,000, they couldn't pull that money back out for groceries or the car payment. Their new credit limit was fixed just above their balance. They were trapped. They had successfully transferred their entire mortgage to a line of credit, and then the bank locked the door behind them. But the nightmare was just beginning, because the other shoe was about to drop: the variable interest rate. A 30-year fixed mortgage is a beautiful, predictable thing. It's like having a landlord who promises, in a legally binding contract, to never raise your rent for 30 years. It doesn't matter if there's rampant inflation or a housing boom. Your payment is your payment. It is a rock of stability in a chaotic financial world. A HELOC is the exact opposite. It's tied to a benchmark rate, usually the prime rate, which follows the Federal Reserve's interest rate decisions. In a stable economy, this might not seem like a big deal. But during a crisis, the Fed's actions can become wildly unpredictable. For Mark and Sarah, their introductory rate was long gone. As the financial crisis deepened, rates fluctuated wildly. Their monthly interest payment, which was once manageable, began to swell. They were now stuck with a massive loan, with none of the flexibility they were promised, and a payment that was becoming more and more unpredictable every single month. They had traded the safety of a fixed-rate fortress for a flimsy tent in the middle of a hurricane. All their discipline, all their spreadsheets, all their careful planning, it meant nothing. It was wiped out by a single letter from the bank. They weren't reckless. They didn't go on a spending spree. They did everything the gurus told them to do. But the strategy has a fatal flaw. It requires the cooperation of the economy and the bank. And when things get tough, you cannot count on either. This is the single greatest risk of this strategy, and it's the one that is so often glossed over in the rara YouTube videos promoting it. They tell you about the power of being disciplined, but they don't tell you that your discipline is irrelevant when faced with a systemic market correction. It's like being the most skilled sailor in the world, but your ship has a hidden defect that causes it to sink in any storm. Your skill doesn't matter if the vessel itself is unseaworthy. This rug pull doesn't just happen during once-in-a-generation crashes like 2008. It can happen during any regional downturn. It can happen if your local job market takes a hit and home prices in your town dip for a year or two. The bank's risk algorithm doesn't care about your personal financial situation. It cares about its own exposure, and it will always act to protect itself first, even if it means completely upending your life and the very strategy they sold you on. So if the risks are this profound, this potentially catastrophic, why is this strategy still being talked about? Why are there still advocates who swear by it, claiming it saved them hundreds of thousands of dollars in years of their lives? Are they all just lucky? Did they all just manage to navigate this minefield without stepping on a single mine? Or is there something else at play here? Is there a specific type of person, or a specific set of economic circumstances, where this high-wire act actually makes sense? The answer, perhaps unsurprisingly, is that the person who can successfully pull off this high-wire act is an incredibly specific and, frankly, rare individual. This isn't a strategy for the financial everyman. It's a strategy for the financial elite, and not just in terms of wealth, but in terms of discipline, knowledge, and temperament. Let's build a profile of this perfect candidate, the person who might actually stand a chance of making this work. First, and most critically, this person possesses a level of financial discipline that would make a drill sergeant blush. We're not talking about someone who's pretty good with money. We're talking about a person who budgets down to the last penny, who tracks every single dollar that flows in and out of their accounts, and who has an almost monk-like resistance to impulse spending. Every purchase is intentional. Every dollar has a job. When proponents of this strategy say you just need to be disciplined, this is what they mean. They mean that when you get your paycheck and deposit it into the HELOC, you don't suddenly see that massive available credit line as a slush fund for a new car, a vacation, or a kitchen remodel. You see it as a debt to be annihilated with extreme prejudice. For this person, a line of credit isn't a safety net. It's a battlefield, and they are the commanding general of their cash flow, directing every soldier, every dollar, to the front lines to pay down the principal. Most people simply aren't wired this way. The temptation of a 5- or 6-figure credit line is too great. But our perfect candidate is an absolute fortress of financial willpower. Second, this individual has a high, stable, and predictable income. This isn't a strategy for someone working in a commission-only sales job or a freelancer whose income fluctuates wildly from month to month. Why? Because the entire strategy hinges on shoveling massive amounts of cash onto the HELOC balance consistently. You need a reliable, powerful engine of income to drive this process. A variable income creates uncertainty, and uncertainty is the mortal enemy of a variable rate debt strategy. If you have one bad month, the interest charges can start to compound in a way that's difficult to recover from. Our perfect candidate is likely a salaried professional, a doctor, a lawyer, an engineer, a tenured professor, someone whose paycheck is as reliable as the sunrise. This stability allows them to forecast their cash flow with pinpoint accuracy and execute their debt paydown plan without interruption. Third, flowing directly from the first 2 points, this person has a massive positive cash flow every single month. We're not talking about having an extra $200 or $300 left over after all the bills are paid. We are talking about a surplus of thousands or even tens of thousands of dollars each month. This surplus is the weapon. It's the fire hose you use to douse the flames of compounding interest on the HELOC. Without a significant monthly surplus, you're bringing a squirt gun to a house fire. You'll make minimum payments, tread water, and get eaten alive by the variable interest rate. The math only works if your principal paydown dramatically outpaces the interest accrual. So, if you're living paycheck to paycheck, or even if you're a comfortable saver putting away a respectable 10 to 15% of your income, this strategy is almost certainly not for you. The ideal candidate has an income so far above their expenses that they can deploy a shocking amount of capital directly at the debt, month after month after month. Fourth, our perfect candidate already has a large, fully funded emergency fund, completely separate from the HELOC. This is a non-negotiable prerequisite. Many people who pitch this strategy make a fatal error. They frame the HELOC itself as the emergency fund. They say, if the car breaks down, just draw from the HELOC. This is a catastrophic mistake. If you are using your HELOC as your primary tool to pay off your mortgage, it is no longer an emergency fund. It is an active, volatile debt instrument. Our candidate understands this. They have 6, 9, or even 12 months worth of living expenses sitting in a high-yield savings account or another safe, liquid account. This fund is a firewall. It's the buffer that protects their entire financial plan from life's inevitable curveballs. If a major, unexpected expense arises, they use the emergency fund, not the HELOC. This prevents them from ever having to add to their HELOC balance in a time of crisis, which could send their entire plan into a death spiral. And fifth, this person has a sophisticated understanding of macroeconomics and interest rate dynamics. They aren't just a passive consumer of financial products. They are an active and educated participant. They know what the federal funds rate is and how it influences the prime rate, which in turn dictates their HELOC's interest rate. They read the financial news, they understand the Federal Reserve's mandates, and they have a well-reasoned opinion on where interest rates are likely to go in the next 1, 3, and 5 years. They are comfortable with and have a plan for interest rate risk. They've run the numbers and know exactly how much their payment will increase if rates go up by a quarter, a half, or a full percentage point. They are not flying blind, they are flying with a full instrument panel in a storm and they know how to read it. So, when you combine these 5 traits, ironclad discipline, high and stable income, massive cash flow, a separate robust emergency fund, and deep financial literacy, you begin to see that this isn't a strategy for the average American homeowner. It's for a very particular archetype. Furthermore, it's not just about the person, it's about the economic environment. This strategy is most attractive and least dangerous during a very specific economic season, a period of low and stable, or even consistently falling interest rates. Think about the decade following the 2008 financial crisis. The Federal Reserve kept interest rates near zero for years. In that kind of environment, a variable rate HELOC was incredibly cheap. You could borrow money for 3 or 4%, and the risk of that rate suddenly skyrocketing was minimal. People who used this strategy successfully during that period were riding a massive tailwind of accommodative monetary policy. But what happens when the season changes? What happens in an environment like we've seen more recently, where inflation is a concern and the Federal Reserve is actively and aggressively hiking interest rates to cool down the economy? In that world, this strategy becomes exponentially more dangerous. That HELOC you took out at 4% could climb to 6%, then 8%, then 10% or higher in a matter of a year or two. The interest savings you were so proud of evaporate overnight. Suddenly, you're paying more in interest than you would have on your old, boring 30-year fixed-rate mortgage. You've traded the safety and predictability of a fixed rate for the terror of a payment that can climb relentlessly, month after month. You thought you were cleverly navigating the currents, but the tide turned, and now you're being pulled out to sea. So the perfect candidate isn't just a financial superhero. They are a financial superhero who also happens to be executing this plan during a Goldilocks economic period of low and falling rates. It's the combination of the right person at the right time. This is why you might see it work for certain types of people, like a sophisticated real estate investor who uses their home equity to quickly fund their next flip and understands how to hedge interest rate risk, or a business owner who has massive lumpy cash infusions and uses the HELOC flexibility to pay down huge chunks of principal at a time. They are treating their personal finances with the same ruthless efficiency and risk management as a corporate CFO. They are not the average family just trying to get out of debt a little bit faster. For them, it's a calculated business decision. For most everyone else, it's a gamble against the house where the house is the Federal Reserve. And that's a gamble you're not likely to win. So let's talk about that gamble. When you take out a 30-year fixed-rate mortgage, you are making a deal with the bank. You are locking in a rate for 3 decades. If interest rates in the wider economy shoot to the moon, it doesn't matter. Your payment is your payment. The bank took the risk on future interest rates, and in exchange you pay them a premium for that security. But when you switch to a home equity line of credit, you flip the script. You are now the one shouldering 100% of the interest rate risk. You are essentially telling the bank, "Don't worry, I'll take the risk. I'll bet that interest rates will stay low, or that my income will grow fast enough to cover any increases." You are personally underwriting the nation's monetary policy. Think of it like this. The federal funds rate is a giant battleship in the middle of the ocean. Your HELOC is a tiny rowboat, tied to that battleship with an unbreakable chain. When the battleship is sitting still in calm, sunny waters when rates are low and stable, you can paddle around feeling free and clever. You're moving fast, you're agile. But the captain of that battleship doesn't know you exist. He's not thinking about your rowboat. He's trying to navigate global economic currents, fight inflation, and avoid icebergs. And when he decides to turn the battleship or fire up the engines to full speed, your little rowboat is going for a ride whether you like it or not. You will be dragged violently through whatever waters he chooses to sail into. You don't get a vote. You don't get a warning. You just have to hang on for dear life. This isn't a theoretical problem. Let's imagine a couple, we'll call them Dave and Jessica. In 2021, they're watching these videos. They're smart, they're disciplined. They have a $300,000 mortgage at 3.5%. They take out a $350,000 HELOC. The prime rate is low, so their HELOC rate is just 3.25%. They do the swap. They pay off the mortgage entirely. Now all their paychecks go into the HELOC. They use it like a checking account. And it's working beautifully. The average daily balance is dropping fast. They're calculating they'll be debt-free in 7 years instead of 27. They feel like they've discovered a secret cheat code to wealth. They're telling their friends, they're posting on forums. They've beaten the system. Then 2022 happens. The battleship starts to turn. The Fed begins one of the most aggressive rate hiking cycles in modern history. Dave and Jessica's 3.25% HELOC rate was tied to the prime rate. As the Fed raises its rates, the prime rate follows in lockstep. Suddenly, their 3.25% becomes 4%, then 5%, then 6, 7, 8%. By mid-2023, their interest rate has more than doubled. Let's do that math. On their $300,000 balance, they were initially paying about $812 a month in interest. Now, at an 8.5% rate, they're paying $2,125 a month in interest. Their interest cost has skyrocketed by over $1,300 a month. All that progress they were making, it's being devoured by interest. The velocity of their debt paydown grinds to a halt. They're now running on a treadmill that's been cranked up to a full sprint, and they're just trying not to fall off. They haven't done anything wrong. They're just as disciplined as they were on day one. But the game changed and they were on the wrong side of the bet. This brings us to the second and perhaps more insidious risk, human nature. The very structure of this strategy is at war with basic human psychology. A traditional mortgage is a forced savings plan. It's beautifully simple. A bill comes for a set amount, you pay it. Every single payment has a portion of principal baked into it, so you are always, even if it's just by a few dollars, building equity and reducing your debt. It requires zero active thought. It's financial discipline on autopilot. A HELOC is the exact opposite. It is a giant, open, tempting pool of cash that is secured by your home. The gurus tell you to dump your entire paycheck into it to lower the balance. That part is easy. The hard part is everything that comes after. The car needs new tires. The kids need braces. That vacation to Hawaii looks really affordable when you see a $150,000 available credit line every time you log into your bank account. A mortgage forces you to live on what's left after you've paid the house. The HELOC strategy requires you to have the iron-willed discipline to pay for your life, and then have enough left over to aggressively pay down the principal. It replaces a simple automated system with a complex, manual one that demands constant vigilance. It's like canceling your weekly grocery delivery service and moving into an all-you-can-eat buffet, telling yourself you're only going to eat the salad. For some people, that works. For most, it's a recipe for disaster. Let's go back to Dave and Jessica. As their interest payments are ballooning, life happens. Their air conditioner dies in the middle of July. It's a $7,000 repair. Where does that money come from? They don't have $7,000 in a savings account because their savings is the HELOC. So they draw that money from the HELOC. Their balance, which they were fighting so hard to keep down, just shot back up by $7,000. Now they're paying that new crushing 8.5% interest on a larger balance. It's a debt spiral. They are now further from their goal of being debt-free than they were a year ago, and they're paying more for the privilege. And this is where we have to talk about the scariest part of this whole equation. The H in HELOC stands for home. This isn't a credit card. You haven't just gambled with your monthly budget. You have put the physical roof over your family's head on the poker table. When you default on a credit card, they send you nasty letters and tank your credit score. When you default on a HELOC, they can take your house. And the process can be much swifter and more brutal than a traditional mortgage foreclosure. You've willingly converted your most stable, secure asset into a volatile, high-risk financial instrument. The risks don't even stop there. What happens if you lose your job? With a fixed mortgage, your payment is what it is. You know the exact number you need to come up with. With this HELOC strategy, your ability to pay down the principal evaporates overnight. You're now stuck with a massive variable rate loan and no income to throw at it. The interest continues to rack up, and the bank starts getting nervous. Or what if the housing market takes a dive? Your $500,000 house is now worth $400,000, but you still owe $300,000 on the HELOC. You're underwater. The bank, seeing its collateral is worth less, can get spooked. They can legally freeze or even reduce your available credit line. Imagine being halfway through this strategy, and your bank suddenly cuts your credit line in half, demanding you pay back the rest on an accelerated schedule. It's the ultimate rug pull, and it's written into the fine print of the contract you signed. The reality is, this strategy doesn't just ask you to be a disciplined budgeter. It asks you to be a flawless cash flow manager, an expert interest rate forecaster, and a stoic risk manager, all while your family's single greatest asset is on the line. The peace of mind that comes with a predictable, boring, 30-year fixed mortgage is a non-financial asset, but it has immense value. It's the ability to sleep at night, knowing that no matter what the Federal Reserve does tomorrow, your house payment will be the same. This strategy forces you to trade that peace of mind for the mere possibility of paying off your home a few years faster. So we've seen the dream and we've walked through the nightmare, the potential for freedom, and the very real possibility of ruin. The question isn't just, can this work? The real question is, what kind of person does this work for? And more importantly, how can you take the principles behind this strategy, the idea of using your cash flow more efficiently, and apply them safely without betting the farm? That's where we go next. So let's draw a portrait of the perfect candidate for this high-wire financial act. Who is this person? First and foremost, they are a master of their budget. I don't mean they just kind of track their expenses. I mean they are a spreadsheet wizard, a budgeting app ninja. They know where every single dollar goes every single month. They have zero consumer debt, no credit card balances, no car loans. Their financial life is a fortress of discipline. This strategy is not a tool to get organized. It's a tool for people who are already hyper-organized to optimize their capital. Second, this person has massive and reliable cash flow. We are not talking about someone who is saving a couple $100s a month. This strategy only works if you have a significant surplus, thousands of dollars every single month, that you can fire hose at the HELOC balance. Think of a dual-income household with two high-paying stable jobs, or a successful small business owner whose income is lumpy, but consistently large over the course of a year. They need to be able to absorb a bad month or an unexpected expense without even flinching. because the interest on that HELOC is accruing daily. A single month of financial trouble could set them back significantly. Third, this person has an iron stomach for risk. They have to be completely comfortable with the fact that their interest rate is variable. They understand that the Federal Reserve could raise rates, and their monthly payment could jump overnight. They also have to accept the risk, however small, that the bank could freeze or reduce their line of credit with little warning, potentially leaving them in a catastrophic financial position. This isn't a gambler. It's a calculated risk taker who has contingency plans for their contingency plans. They have a large emergency fund completely separate from their home equity, ready to deploy if things go sideways. And finally, they have a stable life situation. They aren't planning a major career change, they aren't expecting a new child that will drastically change their budget, and they are in a secure industry. Any major life disruption can derail this finely tuned machine. So, when you paint that picture, you realize this strategy is for an incredibly small, incredibly specific slice of the population. It's for the 1% of the 1% in terms of financial discipline and stability. For the other 99% of us, attempting this is like trying to perform surgery after watching a YouTube video. The potential for disaster is just too high. But here's the most important part of this entire discussion. Just because the strategy itself is too risky for most doesn't mean the principles behind it are worthless. In fact, the core ideas are pure gold. The goal is to make your money work harder, and to reduce the total interest you pay over the life of your loan. And there are much safer, yet still incredibly powerful ways to do that. Let's call the first one the hybrid approach. You keep your safe, predictable, low-rate fixed mortgage. You do not touch it. But you also open a home equity line of credit as a strategic tool, not a replacement. You use it as your supercharged emergency fund and opportunity fund. For example, let's say a major $5,000 home repair comes up. Instead of pulling cash from your savings, you put it on the HELOC. Then, you immediately pay off that $5,000 balance from your savings account. Why? It keeps the line of credit active and demonstrates to the bank that you're a responsible borrower. More importantly, it allows your primary cash savings to remain liquid and untouched, earning interest in a high-yield savings account, ready for a non-house-related emergency like a job loss. You're using the bank's money for short-term needs while your own money stays safe. The second, and I think the most powerful strategy for most people, is what I call the cash flow sweep. This mimics the best part of the HELOC strategy, using all your excess cash flow to attack debt, without any of the risk. Here's how it works. You set up a separate dedicated savings account. You can even nickname it Mortgage Annihilator. At the end of every month, after all bills are paid, whatever cash is left over in your checking account gets swept into this fund. $100? Sweep it. $1,000? Sweep it. Got a work bonus? A tax refund? Sold something on Facebook Marketplace? It all goes directly into the Mortgage Annihilator account. Then you set a trigger amount. Maybe it's $500, or maybe it's the exact amount of one extra mortgage payment. As soon as the account hits that trigger, you immediately make a lump sum, principal-only payment to your mortgage lender. This is profoundly powerful for two reasons. First, it's psychologically motivating. You see that account balance grow, and you get a jolt of satisfaction every time you deploy it to obliterate a piece of your mortgage principal. It gamifies paying off your home. Second, it's completely safe. Your money is in an FDIC-insured savings account. There's no variable interest rate. The bank can't call your loan. You are in 100% control. You get all the focus and intensity of the HELOC strategy with none of the terrifying downside. And finally, there is the simplest, most timeless strategy of all: making consistent extra payments. This is the bedrock of accelerated mortgage payoff. There are two easy ways to do this. First is the bi-weekly method, but you can do it yourself. Just take your monthly mortgage payment, divide it by 12, and add that amount to your payment each month. By the end of the year, you'll have made one full extra payment. The second way is to simply round up. If your payment is $2,180, round up and pay $2,300 or even $2,500 every single month. But here is the critical, non-negotiable rule for this method. You must ensure that extra money is being applied directly to the principal. When you make the payment, whether online or with a check, you have to designate the extra funds as principal only. If you don't, some lenders will just apply it to next month's payment, essentially holding it and paying you no interest, which does absolutely nothing to reduce your loan balance or save you money on interest. You have to be your own advocate and check your statement every month to make sure that extra payment is reducing the principal balance. So what's the final verdict? The idea of paying off your mortgage in 5 to 7 years with a HELOC is a seductive one. It speaks to our desire for a clever shortcut, a secret financial hack that the pros use. But in reality, it's a financial bazooka. In the hands of a highly trained expert under perfect conditions, it can hit a target. In the hands of almost anyone else, it's far more likely to cause devastating collateral damage. The real secret to paying off your mortgage early isn't a secret at all. It's not about finding a complex financial instrument. It's about discipline. It's about intention. It's about creating a system like the cash flow sweep that turns your income into a focused weapon against your debt. It's less exciting, it's not a hack, but it is undeniable. It works every single time. The American dream isn't just about owning a home. It's about achieving the financial freedom that comes when your home no longer owns you. And that freedom isn't built on risky bets or complicated leverage. It's built brick by brick, extra payment by extra payment, with the steady, unwavering discipline to see it through to the end. That is a foundation that will never crack.